Market crashes follow a predictable pattern that has been repeated throughout the past century. While most investors panic and lose money, others use a specific approach to multiply their wealth during these times. I spent 10 years studying every major market crash since 1929, uncovering something remarkable. Crashes function like seasonal storms, clearing out weak investments while nourishing stronger ones. These aren't random disasters, but calculated wealth transfer events where money moves from the unprepared to the prepared. What follows is a proven script that separates winners from losers in these financial storms. Let me show you the strategies that determine which side of wealth transfers you'll experience when markets tumble. What if I told you that market crashes aren't random events, but follow a specific script that repeats over and over? These financial disasters that seem to come out of nowhere actually leave behind clear footprints if you know where to look. The stock market has crashed 14 times in the last century, which breaks down to roughly once every 7 to 10 years. Think about that for a second. These unexpected events happen with shocking regularity. Most people think market crashes are unpredictable financial tsunamis, but history reveals distinct patterns signaling their arrival, like warning lights on your car's dashboard that illuminate before engine trouble. These warning patterns become evident when examining major market collapses. 1929, Great Depression, 89% market value erased. 2000, dot-com bubble, 5 trillion market value vanished. 2008, housing crash, 56% market decline. 2020 COVID crash, 35% drop in just 33 days. These footprints left by these crashes consistently show 3 key warning signals. Rising inflation comes first. When prices climb faster than normal, the Fed typically raises interest rates, often triggering market turmoil. Second, political instability creates certainty that markets despise. Third, excessive market optimism emerges when everyone's making money and even taxi drivers start giving stock tips. The 2008 financial crisis perfectly illustrates these warning signals. Months before the crash, housing prices showed classic bubble behavior, increasing over 100% in 7 years, completely disconnected from income growth. Mortgage lenders approved loans for virtually anyone, yet most ignored these warning signs because real estate always goes up. The aftermath proved otherwise. Professional investors closely monitored the VIX, the market's fear index, during calm periods. It hovers around 15 to 20, but when it spikes above 30, it indicates investor panic. Before the 2008 crash, the VIX skyrocketed from 20 to over 80, a warning flare lighting up the financial sky. Market corrections, 10% drops from recent highs, and bear markets, 20% drops, prove additional signals. Corrections happen almost yearly and typically recover quickly, while bear market signals deeper problems. These movements communicate underlying issues in the financial system. 3 particularly valuable signals appear before virtually every market crash. VIX spike index over 30, indicating extreme fear, extremely negative investor sentiment in surveys. Company insiders start to buy their own stock after significant declines. What makes these signals so powerful is that they're based on actual market behavior, not theories or predictions. The average investor misses them because they're too busy following headlines or getting investment advice from social media. But now you know what to look for: actual patterns that have repeated through every major market crash in history. Those market patterns signal danger to average investors but opportunity to billionaires. Warren Buffett seems almost cheerful during financial catastrophes while everyone else is panicking. That's because the wealthy understand something most people don't. Their fortunes aren't made during bull markets, but during the chaos of market crashes. When you see headlines about market meltdown, what's really happening is a massive wealth transfer. Money isn't disappearing, it's changing hands. Consider what happened on Black Monday in 1987. While most investors fled the market, Buffett calmly invested $1 billion in stocks, later calling it like buying merchandise at a discount. The unprepared panics sell at the bottom, and they're prepared step with cash to buy those assets at fire sale prices. This pattern plays out in every market cycle. Think about what happens when markets start falling. The average investor watches their portfolio drop 10%, then 20%, then 30%, and fear takes over. They sell everything, convert to cash, and swear off investing. Meanwhile, the wealthy investor has been waiting for this moment. They've kept 20 to 30% of their portfolio in cash reserves because they understand market cycles create opportunities with remarkable regularity. Amazon dropped 90% during the dot-com crash. Investors who recognized the company's long-term potential and bought during that panic were rewarded tremendously. A $10,000 investment in Amazon at its low point in 2001 would be worth more than $4 million today. Every market crash offers similar opportunities. Quality companies available at incredible discounts when fear overtakes greed. The psychology behind these behaviors is fascinating. During market crashes, the logical part of our brain gets hijacked by the monkey mind. The survival-oriented brain region perceives the crash as danger and screams, "Run!" This emotional response drives poor decisions during market turmoil. The wealthy train themselves to overcome this emotional response. When the market crashes, they see a clearance sale on premium assets. As Buffett says, be fearful when others are greedy, and greedy when others are fearful. The ultra-wealthy employ two key strategies. First, they maintain dry powder, cash reserves kept specifically for buying opportunities during market crashes. They hold cash because crashes are inevitable, and they prepare accordingly. Second, they implement disciplined dollar cost averaging during downturns. Instead of timing the exact bottom, they buy fixed amounts at regular intervals as markets fall. This approach ensures they acquire assets at favorable valuations without emotional pitfalls. When the S&P 500 dropped 34% in just 33 days during March 2020, prepared investors with available cash purchased excellent companies at 30 to 40% discounts. The wealthy view these as rare events as opportunities to acquire high-quality assets at prices that may not appear again for years. Market crashes happen like clockwork, roughly once every decade since records began, yet most people act shocked and unprepared when they arrive. What separates those who lose everything in market downturns from those who emerge wealthier isn't luck or timing. It's avoiding a single catastrophic decision that your emotions will desperately try to convince you is the right move. Here's the shocking truth. The average investor consistently earns 4 to 5% less than the market itself each year. This happens because when markets get volatile, your emotions take over and force us to making terrible decisions that permanently damage our long-term returns. We're biologically wired to run from danger. When our portfolio starts dropping rapidly, every instinct screams at us to escape the pain and uncertainty. The feeling of watching your hard-earned money seemingly evaporate creates an almost unbearable psychological pressure. To understand why market crashes feel so devastating, financial experts use something called the pain index, which measures both how far markets fall and how long they take to recover. The 1929 crash that triggered the Great Depression stands out as the benchmark at 100% of this index. If you had invested $100 right before the crash, you would have watched your investment shrivel to just $21. By May 1932, a staggering 79% loss. This means for every $10,000 invested, $7,900 vanished, enough to buy a home in that era. Let's examine two different investors during market crashes. Investor A panics and sells everything when their portfolio drops 30%. They wait until they feel comfortable about the market again, usually after it's already recovered 20% or more, before getting back in. Meanwhile, Investor B feels the same fear but sticks to their long-term plan, continues regularly investments, and may even invest more during the crash. Every market crash in history shares one crucial characteristic: they're temporary. The permanent damage happens from our response to it. When Investor A panics, sells during a downturn, they're essentially burning the bridge to their financial recovery. They transform temporary paper losses into actual realized losses that can never be recovered, like cutting off a limb rather than treating a treatable wound. 5 years later, Investor A has permanently lost significant wealth and buying power. Their emotional decisions created a wealth gap that can never be closed. Meanwhile, Investor B not only recovered, but likely saw their portfolio reach new heights because they continued buying when prices were low. Bull markets historically last much longer than crashes. While downturns can be sharp and painful, the long upward trajectories that follow tend to reward patient investors. The challenge is that our psychology makes us hyper-focus on short-term losses while undervaluing long-term gains. True danger in market crashes isn't the temporary decline in asset value, it's the permanent damage caused by emotional making. So, we've covered a lot today, but here's what you really need to remember. The difference between losing your shirt and building serious wealth during market crashes isn't about having a crystal ball. It's about preparation. Having a solid plan before the market tanks is what separates winners from losers in this game. The smartest investors keep cash ready, use dollar cost averaging, and diversify intelligently. Their secret weapon? Emotional control. While others panic, they execute their strategy with discipline. Ready to transform market chaos into opportunity? Prepare now. Build your cash strategy, master your emotions, and position yourself to profit while others flee.